Hi everyone, my name is Simon Mishevich from Optimise Accountants, and in this video we are going to be talking about the Labour Party and the likely impact on inheritance tax. So we all know about the manifesto of 2024, but things are, as it says there, going to change. And the Labour Party don't seem to like people with money. No, they like to tax them heavily to the point that they just leave, which is interesting because I have a channel talk about international taxation, which is just here. If you are thinking about leaving the UK because of what's happening with the Labour Party, do what I did, leave the UK. I have got a channel for expat international taxation for US and UK citizens, so feel free to see that channel more about taxation. And if you're interested in moving to Spain, I've also got a channel for that. So use the QR code or indeed just use the links in the description box below. Okay, so inheritance tax, let's have a look at the current situation. So inheritance tax free is £325,000 for the individual or £650,000 for a couple. And that is the net asset value. So let's imagine that you have a house that has a gross value of £500,000, but you have a mortgage on it of £300,000, the chargeable to inheritance tax is £200,000. But because that's below the £325,000, there's no inheritance tax. So it is only based the net assets. It's not the gross asset value. Now, there is the residential nil rate band as well. So if you've got a house of a certain value above £325,000 rather, you can get the additional IHT free band called the residential nil rate band. £175,000 for an individual or £350,000 for a couple. Combined, you can see there, it's going to be £500,000 worth of net assets, which could be IHT free for an individual, and £1 million, so doubling it up to for a couple. That excess though is going to be 40%. So anything above those amounts, 40% tax. Fair? Not really, not at all. Be interested in your views in the comments box below, please. So, gifting assets as well, we do need to think about this, is a good way to get away from inheritance tax. But you have to live for 7 years. So you give away a property or an asset. If you die within 7 years, it's brought back into your estate. So it can still be subject to inheritance tax. But survive for 7 years, that asset is not part of your estate. There's no inheritance tax. So that's a good thing. And that is currently available to you. Pensions, putting money from your bank account into a pension can get you tax relief on your income tax return. That's good. The money inside the pension is also going to be tax free. Next, we have business property relief. Now, I have a trade business, the accountancy business, and if my son takes over the business and I die, then it could be inheritance tax free as long as the business as a whole is 50% trade, not investment. So we're talking about investments could be buying property to rent out or had stocks and shares. If it's more than 50%, then business property relief would be lost altogether. You've also got agricultural relief. So if you've got farmland, then there could be discounts from inheritance tax. And then excluded property trust. This is not used for British people typically. It's more used by international people that move into the UK and say, well, I've got assets abroad. I want to put those in a property trust, which is then excludes it from UK inheritance tax. And that's possible. And you can still do that right now. Are there going to be changes? Well, of course there is. Otherwise, this would be quite a boring video, wouldn't it? But these changes aren't to be lightly discussed. We do need to think about how this could affect you. Removal or the reduction of IHT for pensions. Putting money into pensions, as I discussed, is IHT free. But the Labour Party is saying, well, we need to cap this. So if you've got big pensions, anything above a certain band, we're going to subject it to 40% inheritance tax. Which is why, because that's just really bad. There's lots of people with big pensions, and if they start adding that back into the estate, well, that's disaster waiting to happen. Second thing, by the way, do I think that that could happen into the pensions? I think that would be a hard pull and push to get this through legislation, and there could be repercussions on the Labour Party if they even tried that. The second part is the reduction or the removal of business property rollover relief, which is the kind of, if you've got a business, 50% or more is trade, as in not investments. It's not holding buy-to-let property investments or stocks and bonds or whatever as investment. It's a trade. And we mentioned before it's 50% or more, but they're thinking about increasing that to 80%, which again, if you've got a business that has got 30% of cash in investments, it makes loans to other companies, or it's got some stocks and shares or buy-to-let properties, all of that is going to be called investments. And if it's 30%, already you're going to lose out on business property rollover. Now, business property relief, I should say. Now, one thing I would say about that is that they also are talking about the introduction of another £500,000 limit. So if your business is worth $2 million, then that suggests that 1.5 million is going to be subject to inheritance tax. That's aggressive if they do that. I mean, you're handing a business over to someone else. They may even be running that business for you, and yet you're still going to be subject to inheritance tax on death. Again, seems really aggressive. If that's the case, then my advice to people would be, well, relocate your business, relocate yourself, and relocate your business, because corporation tax rates is significantly high in the UK at 25%. There are many countries that have better rates than that, and they don't have inheritance tax. So that's something for you to consider. No uplift on value on asset transfers, IHT and CGT double tax. And I'm going to talk about that in a bit more detail with an example, because I think this one could trip us up in terms of how to explain it and how to understand it. So let's have a look at that. Freeze are after 27-28. Now, at the minute, the inheritance tax band we talked about earlier is £325,000. Now, they've got a freeze already up to 27-28, but they're thinking about extending that freeze beyond those years, which means that anything to do with inflation is going to be ignored. So inheritance tax is actually increasing simply because it has no indexation allowance. So inflation is what, 3-4%? That's ignoring that. Property values are even going higher than 3-4%. So you're going to have problems with the freezing if they go beyond 27-28. In addition, I've heard that the 325,000 IHT free ban could be at jeopardy. It could actually be lowered. And the residential nil rate band also is at risk. So inheritance tax on homes is going to be severely impacted maybe from October onwards. End of excluded property trust. Now, depends which way you look at this. Someone who's coming from a foreign country to the UK is going to have worldwide assets subject to inheritance tax if they've been in the country for a period of time. Is that right? I haven't got an opinion on this, if I'm totally honest with you. If they're in the UK, should they be taxed? I think there's an argument to and for it. I think that UK inheritance tax should be, or UK inheritance tax should be based on UK assets, personally. But there's a lot of people with wealth coming to the UK and have their worldwide assets subject to IHT. The way of getting around that is to say, well, actually, I'll come into the UK, but I've got this property. I'm going to put in excluded property trust for the benefit of my children. I'm going to get that out of my estate for IHT purposes. They talk about putting an end to that, which does that mean that that's going forwards, or does that mean that any properties currently in an excluded property trust is, even in the past, is going to be brought back into your estate? Wow, that's again very aggressive. Let's have a look at an example now of inheritance tax and capital gains tax double taxation. And this is IHT on death. And I'm going to give you total assets and a home. And this is market value of these assets. So total asset value of £3 million. They've got a home of 1.5 million. Now the nil rate band, there's no residential nil rate band because they have utilised that on their other assets. So that beyond 2 million, they lose their residential nil rate band. That means that £650,000 would be allocated to things like cash, investments, stocks, shares, bonds, that kind of thing. So that £650,000 IHT band for the couple is being utilised. So therefore, there's no IHT-free amount for the home. Problem is with that is there is a tax rate on that home of 40%, which means 1.5 million is subject to inheritance tax. The IHT on that home is £600,000. And I will note here that the original cost of that home is £500,000. Now, I don't know what the Labour Party are thinking here. Are they thinking, well, the original value was £500,000 and then we'll bring that into the equation? Or are they still thinking, no, the market value is 1.5 million. That's what the children are going to get. Therefore, we will use inheritance tax on that amount. I rather suspect that they'll value it at market value when you pass it to the child or other people. And therefore, 1.5 million in this example would be subject to 40% tax, which is going to be £600,000, which is substantial. I'm sure you agree. Okay, so CGT then, what happens? So this is before the change and potentially what the Labour Party is talking about going forwards. The asset value is 1.5 million, and we talked about that just a second ago. The market value versus the original cost. If the Labour Party get their way, they could change the market value, which is the cost in this case, for the person selling the property. The child now owning the property sells it, and they are going to have a £1.5 million income from the sale of that property because it was subject to inheritance tax, let's not forget, on the hands of the parents. Now they've got this £1.5 million worth of uplift of cost. But the Labour Party is saying, no, no, no. We want the cost that it was originally bought for to be transferred over to the sibling, to the children. In this case, £500,000 was the original cost of the parents. Taxable gain then, before any changes that the Labour Party might bring in, will be zero because there was a step up in value to 1.5 million. They sold it at 1.5 million. There's no gain. Okay, it was already subject to tax in the form of inheritance tax. So why should it be taxed again? But the Labour Party is saying, well, no, actually, we want to tax it again. So here we say you've got the uplift in value, 1.5 million sale, less the original cost that your parents bought it at £500,000, you made a total taxable gain of 1 million. CGT rate for high rate taxpayers is 24%. So therefore, CGT is £240,000, ignoring any exemptions for now. Plus you have paid, or your estate paid of your parents, £600,000 for IHT. Add those two together, it's £840,000. Wow, on a gain realistically of £1 million. So 84% is what the Labour Party are talking about taking from you as a wealthy individual. That's criminal if this goes ahead. Will it go ahead? I know there's a lot of media talking about this, but I can't imagine they would put this in place. It's just so significantly aggressive that people just wouldn't sell the property. They would keep it in the family. I'm not sure. There's going to be a lot of tax planning required if they do push this one through.